I am sure by now you've heard of the threat of an upcoming recession. The global economic picture seems to be pointing towards higher cost of living, increasing inflation rates, gas and oil prices skyrocketing, and reduced food supply. There are a few things I want to cover in this video. I want to talk about what a recession is, what happens during one, and most importantly, which stocks and which companies you should avoid investing in during a recession, and which ones you should maybe put some money into. So firstly, what is a recession? You hear this word get thrown around left, right and centre, but actually I think it's really useful to sit back and look at what a recession actually is by definition. A recession in its simplest form just means a decline in economic activity. However, a true recession is declared when the economy has 2 consecutive quarters of negative economic growth. So naturally, this is strongly linked to consumer spending, unemployment rates, stock market crashes and fuel price surges. There are a lot of different things that can impact whether a recession is going to happen, but I just don't have the time to dig into all of those during this video. So I guess this leads on to the question of, are we heading towards a recession? A lot of the signs to indicate that there is a recession coming are already present, like oil prices, fuel prices rising, inflation rates going up, etc, etc. However, we spoke about earlier that for a true recession to be declared, there needs to be 2 consecutive quarters of negative economic growth. Well, actually, right now here in the UK, Q1 of 2022 has actually seen positive GDP of 0.8%, which is quite low, but it's still positive. Having said that, however, of course, there still may be an upcoming recession. I guess we will just have to wait and see. Now we've spoken about what a recession is, I suppose we should talk about what actually happens during one. Well, put simply, a recession is not very nice and a lot of bad things happen for a lot of people. Lots of people lose their jobs as companies can't afford to pay them and lay people off. People can't afford to pay their bills or mortgage payments or rent payments, and this even means that lots of people lose their homes even during a recession. The real income, so the income adjusted for inflation, drops, manufacturing drops, sales go down, and it's just not a very nice picture. And of course, aside from the impact of a recession on the people, this also really impacts companies, and a lot of companies just simply won't survive a recession. The last big recession that we can look back on was the financial crisis, the financial crash of 2007-2008, which actually lasted 5 quarters, which is quite lengthy. There, of course, was the recession that we've just seen due to the pandemic, but that was quite a short one and only actually lasted 2 quarters, so half a year, I believe. You could take a look back at which companies actually didn't survive and which companies did survive during the last big recession. And I've got just one example here for you now. Lehman Brothers Holdings was a global financial services firm. They were like the 4th biggest in the US with over 25,000 employees. And they actually filed for bankruptcy in 2008 as they just could not survive the recession. And this is just one company. There were many different companies out there that just could not survive that recession, and there will be many in the future that can't survive upcoming recessions either. So with all this said, how do you know, or how can you best try to predict which companies, which stocks will actually survive a recession? Of course, as an investor, having money in stocks that just won't survive or really don't have a very good chance of surviving a recession is not really a great use of your money. But having money in companies that will survive and even thrive during a recession is a real advantage. And putting money into stocks that will do well during a recession is a way to sort of defend yourself against the economic collapse. And luckily, there are some really, really strong factors that you as an investor can look out for when trying to decide which companies, which stocks in your portfolio may survive a recession if there is one upcoming. The first one is a really simple one, and it's got nothing to do with analysing a company's financials or digging deep into a balance sheet. This one is a very overarching concept, and that is to look for stocks, so look for companies that are actually providing an essential service or an essential product. This is because when people have less money, as they will during a recession, they are more likely to want to spend that money on essential things that they need to live, things like food, medication, and so on, rather than spending that money on luxury items or things that they just don't need to live. Luxury services or products could be things like retail, so buying new clothes, or it could be things like restaurants, going out for meals, and staying at nice hotels. So it is quite a common strategy of investors to actually invest into companies that are really providing something essential during these sort of times. And these are products that people just aren't likely to cut back on if they start needing to cut back on things due to financial pressures. There are many other essential businesses such as funeral services, healthcare, any shop that offers discounted prices, so discount shops. They're really, really popular during a recession because, of course, if people are a little bit strapped for cash, they go in to try and source their essentials cheaper. Goes without saying. Baby product companies tend to do okay during a recession. And of course, debt collection companies. Unfortunately, these tend to also do well during economic downturns. These stocks that are essential are referred to as non-cyclical stocks. So these are the ones that are not heavily impacted by economic cycles, non-cyclical. They're just less prone to market volatility because no matter what's happening, people need them. Whereas cyclical stocks are the ones that tend to only do well when the market is thriving, when people have extra cash that they're looking to spend. These are things like airlines and hotels, and people will often say only invest in non-cyclical stocks during recessions. The next factor to look for is companies with a really strong balance sheet. And this one we can sort of break down into a few different things. Firstly, debt. A boring topic perhaps, but a very important one when you're thinking about which companies to invest in during these times. Those companies with little or no debt have such a higher chance of surviving a recession. Those companies with lots of debt will struggle, and that's because lenders will tighten their terms and interest rates will increase, meaning it will cost companies with loads of debt so much in interest alone that they'll just have a higher chance of making no profit or even going bankrupt. The more debt a company has, the more cash it needs to just even pay its interest, let alone the principal payment. During a recession, less cash is coming into a business, which then means those companies with high amounts of debt really are at risk of defaulting on their payments, which then means they may need to cut back on investments and growth into the business and may even need to begin laying off staff, which of course all means that they then have less chance of making money, they're less likely to pay off their interest and their debt, and yeah, you can just see where this one's heading. Another thing that you can take a look at is the debt to asset ratio, as this can give an indication of the stock's stability. So this means taking a look at the liabilities of a company and comparing this in the form of a ratio to the assets of a company. During the 2007 to 2009 recession, we saw how critical it was for investors to avoid investing in those companies with really poor balance sheets. As from the peak of the stock market in October 2007, right the way down to the lowest point in March 2009, those companies that had really high amounts of debts and really poor balance sheets overall didn't do very well. They actually underperformed the S&P 500 by about 10%, and actually many of those companies didn't even survive. So I think what I'm trying to say here is that although it's always really important to look at the finances of a company and analyze balance sheets and all that fun stuff before you invest in them, during times of economic downturn, it's more important than ever. Another thing that fits into this whole idea of balance sheets is cash and cash flow. This may be one of the biggest indicators actually as to whether a company could survive a recession. Having a good cash flow is really, really important as a business, as a company, when there is a market crash or a long haul recession. And that's because these companies, well, firstly, they're probably not in debt, which is always a good thing during recession. But also, if they've got a really good cash flow, they're not going to be so affected by waiting for invoices to come through. And of course, during a recession, lots of companies and lots of companies can't actually afford and can't pay and follow through on their invoices, which of course, if you're a company relying on invoices, it's not going to go too well. And also, if you've got lots of cash, you can afford to keep your business afloat when things aren't very well. You can afford to pay your staff, so on. You're just not going to need to take out loans and get into debt if you have a good cash flow. The final factor to talk about today is non-speculative stocks. Now, these ones tend to do better during a recession. Speculative stocks, however, are those that are fueled and pumped during market bubbles, when the market is doing really well. The reason that speculative stocks don't do well during a recession is because when times are tough, people are less likely to risk their money. they're not going to want to put their money into something speculative and something risky. They're going to actually pull it out of those investments and put it into what they deem a safer investment, which of course can cause those speculative ones to actually crash and burn. We can say bye-bye. Now over to you guys. If there are any factors that I've missed that you think are important for people to know, then please leave them in the comments below. And also, please leave your thoughts on particular companies that you think are going to do well and those that are not going to do so well if there is an upcoming recession. Having said that, I just want to say a quick disclaimer about this video. I'm not a financial advisor, and nor am I trying to predict whether there is a recession, nor am I trying to tell you what to do if one does come.